How should you audit the risk in your portfolio? And is CVS a buy or sell after the latest earnings report?
This is InvestTalk. Independent thinking, shared success.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Monday, May 13th, 2024 edition. I'm Justin Klein, and here again on this Monday is Luke Guerrero with us. Thanks for being here, Luke.
Yeah, thanks for having me. Hope you had a relaxing weekend, or at least as relaxing a weekend as I did.
I did. It was very relaxing. I am currently, I don't know if anyone knows, I'm recovering from minor foot surgery. Some bone spurs in my toe that I had to get cleaned up. So
toe spurs.
Toe spurs. There you go. So by doctor's orders, I definitely took it easy. But that doesn't stop me from being here and helping our listeners, and that's what the goal is each and every weekday, is help you become a better investor by giving you educational material as well as some perspective, developed over 20 plus years of investment experience. And of course, we do that by answering your finance and investment questions, which you can call, you can leave a message, you can leave comments on our YouTube channel. There's so many ways to get your question to us, and whatever way works for you, we encourage it. Now, we're going to talk about the market performance for today and run down some show topics, but right after we tackle our first caller question now.
Hi, I own CVS stock shares, and there was a recent decline in the stock. I'm a long-term investor, so I wanted to see if you had any feedback on the stock, whether I should buy more. I do plan on holding it, but with the recent dip in the stock price, I was wondering if this would be just an opportunity to buy more if it was a long-term investment. I would appreciate any feedback. Thank you.
All right, looking at CVS Health Corporation, and yeah, they recently had some earnings, and it was a bad earnings report. There's no way to color it any different. Revenues are up 4%, but earnings were down 40%. 4-0. Free cash flow took a big dip. Now it's the lowest level trailing 12 months since pre-pandemic. And we had to own this for clients, and we hated the report so much we shut it and moved on. So collected some dividends over time. Overall, probably was a mild net loss, but sometimes you just have to be frank with the state of the business, and it's not nearly as strong as we imagined it would be. So that pivot towards being more of a healthcare store versus just your standard run-of-the-mill drugstore, it's not working out quite as well as we all hoped. It wasn't looking good enough on the charts or in the fundamentals to hold on. So I would move on. Anything to add, Luke?
Yeah, just to say, one of the big reasons for their bad forward-looking guidance and bad earnings was because of the utilization of their insurance was, I believe, 60% or so higher than they expected it to be, and that really pushed down profits. And so it's going to be difficult for them to fight against the demographics of this country, which are hurting their bottom line. So I think that's another one of the reasons why we decided to move on. And just because you see a dip, it doesn't mean it's a good dip to buy. And so I think that's probably the case here.
Yeah, sometimes you get it wrong, and sometimes you have to just make amends and move on. So that's what we did, and I would encourage you to do the same. Now, our focus point today concerns this question: does your portfolio need a risk audit? And there are many ways to identify the risks hiding in your portfolio, and we will go into deeper detail in a little bit. Talk about risk management, portfolio management, and how to identify those risks in your portfolio. In addition, we have some other topics on the docket as well. One is in regards to rumored tariffs, Chinese tariffs, passed by, no, not the Trump administration, but the Biden administration, that looks to take effect here later this week, or at least be announced later this week. So we're going to look at that. And then also pandemic era winners. It was a very unique time, to say the least, in 2020. And the trends within the markets were all over the place. Up, down, sideways, and many parts of the market that were at least short-term benefiting from the pandemic shutdowns. they did very, very well. But some, in fact, most did not keep that momentum, and many lost that momentum down 60, 70, 80, 90% from their highs. So we're going to revisit that a little bit and see what lessons can be taken away. And then lastly, if we have time, the weight loss revolution. We're talking about Ozempic and the similar weight loss drugs and what impact that might have on the earnings of companies involved in that product, but also the downstream effects in the food industry. So we're going to look at that and see how these trends may be playing out, and can you play them yet? Okay, so we're going to look at that. In addition, we have some voice bank questions. One is in regards to the materials sector as well as innovative industrial properties, IIPR. And we also have questions that came in through the comment section over on our YouTube channel that we will get to as well. But we welcome your finance and investment questions live at 888-99-CHART. And we're going into a short break. And on the other side, we're going to look at the market activity for today and take questions from the InvestTalk Anytime listener line. Once again, the number is 888-99-CHART.
You are invited to be a part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART.
Enjoyed our insights on InvestTalk? Great news. Our podcast is available on all major platforms. Make sure to subscribe wherever you listen to your podcasts. Get the latest in investment advice across Spotify, Apple Podcasts, and more. Subscribe now and join our community of informed investors. Now let's take a look at the market today. It was kind of a mixed day overall. Mid caps down the most, small caps up a little. Kind of a mixed bag as we head into a more exciting week than last week. We talked about how last week was kind of a boring week overall, especially since we were on the back end of earnings season. But we have some inflation data coming up later this week, right, Luke?
Yeah, that's true. We got PPI this week. We got CPI this week. I think it was more of a continuation today from what we saw last week. Like you mentioned, there's really been a market-moving vacuum. There's been no real catalyst that could move the market one direction or the other. I saw the New York Fed's latest survey showed a rise in 1-year and 5-year inflation expectations, but that didn't seem to be enough to move the market. S&P 500 closing pretty much flat. Russell 2000 only up 11 basis points. The meme stocks did really well today, as you and I were discussing earlier. GameStop was up over 70%, I think, at the close.
Yeah, that was probably the most interesting part, right, of today's market.
It was. The mark-to-market losses for the shorts was about $1 billion today. So
wow, that's probably why small caps were up a little.
Could be,
right?
Yeah, could be.
Big moves in GameStop and AMC. And
AMC
it's all has to do. Why don't you explain to the audience? You were talking. I don't know it as well as you do, since I know you are a Reddit fan, so you know that the Reddit boards were on fire for many years, and they kind of calmed down for a while, and now they're coming back to life, right?
Well, they're coming back to life in a way. It's interesting because several years ago, the way the meme stock craze started was that a user on the Wall Street Bets subreddit came in and actually had a decent fundamental and technical analysis of why they thought GameStop was undervalued, and also included the fact that it had like 20% short interest. And so that skyrocketed the price over time. Melvin Capital hedge fund was liquidated. They either had to be bailed out by Citadel or they don't even exist anymore. I don't recall. But fast forward 3 years, this same poster, who hasn't made any noise since then, essentially posted on Twitter a video, or rather a photo meme of somebody leaning forward. And I guess that is enough to get the gamblers in Wall Street Bets to help pump GameStop's price by 74.4% today.
Yeah, so anything with a high short interest that has a decently well-known name got a nice bump today. AMC up 78%, GameStop up 74%, and yeah, interesting market today. We'll see if that lasts or it's a flash in the pan. As we know, usually these short squeezes, there's not a whole lot behind them. But
I think it's important to note here, this is a good lesson because people who decided to purchase GameStop, which fundamentally was way above its intrinsic value by a lot of metrics at the top, even after today's mess, still down 75%. So it's best not to hop on these trains after they've already been made public.
Well, if you do, you want to sell quick. Take your profits if you have any and get out, and don't think that these are long-term holds. Because I remember I've seen, posts that where people are still hanging on hope that, there's going to be the next short squeeze, and they're holding on for years on end, and it's just getting ground to oblivion. So even when you do get hope like this, it's not getting them back even. So it's better
even the people that have been holding out hope for a year, still down 75%. So
now you probably noticed that we are answering questions submitted via viewers by viewers on our YouTube channel. That's because we post the podcast in video form each weekday. And here's one that came in just a few days ago. LSXVG says, what's your opinion on Gibraltar? There we go. Gibraltar Industries, ticker symbol ROCK, ROCK. Love the symbol. It earned the thumbs up. If it earns a thumbs up, what do you see as a good entry point? What do you see on this name, Luke?
Yeah, well, if you're looking at how it's operated historically, I know that they gave some pretty volatile guidance coming out of Q4, and they had some mixed Q4 results. What they do is they make products for renewable energy, residential ag tech, and global infrastructure markets. I think this is actually a good lead into the story we're going to be talking about today, which is the headline being the Biden administration increasing tariffs on EVs. But really what it's doing is it would be increasing tariffs on the parts to make those EVs and the parts to make some of this renewable energy tech to hope to make U.S. renewable energy firms more successful. And so, even coming out of the mixed results and the bad looking guidance from last quarter, I mean, they only got $46 million in debt on a $2.2 billion company. Their cash flow is improving, their profitability is improving. And I think maybe one of the things that have been holding them back is some competition from overseas. So, I think it's an interesting name to think about in the wake of what might be happening politically, but I'm not sure it's enough to harm some of the demand side issues that this company's been seeing.
Yeah, this has
help against those.
This kind of has a dual narrative because, like you said, it does have a renewable segment that designs, engineers, manufactures, and installs solar racking and electrical balance systems. But it also has an ag tech segment, which provides growing and processing solutions, including designing, engineering, manufacturing, maintenance, and support of greenhouse and indoor growing operations. So think of medical cannabis, for example, or just retail cannabis now. So there's kind of dual tailwinds here, which I kind of like. And that's why earnings continue to go up. And that's why I would say I like it, is that there's just a consistency of growth to the earnings that shows that there's a lot of consistent tailwinds. 2017, they made $1.71, and they've made more money every single year, even during the pandemic. It's supposed to go to an all-time high of $5.32 next year, which puts it at a roughly 15 times forward-looking multiple. That's not bad. Now, the technicals are weakening. I will say that. I don't love the recent action where it peaked right around $87 per share, and now we're at 74. A major support, though, would come in down around 65, and that's probably where I would pick it up. So definitely a high-risk name, but some nice tailwinds potentially that will keep the earnings continually growing. Well, we're heading into a short break, but we always enjoy your voice bank calls. But most importantly, we love your live calls during the podcast, and that's why we encourage you to give us a call now at 888-99-CHART. Hey, InvestTalk community. Justin and Luke here. We are so thankful you've been with us through this investing journey, but we are just getting started.
That's right, Justin. We're excited to bring you more exclusive content. Think more of the critical analysis and expert advice that you love.
You'll get insights into smart investing strategies to help you navigate these turbulent times.
Don't miss our live Q&A sessions every weekday at 4 p.m. Pacific, where we answer your burning investment questions.
Just call our InvestTalk listener line at 888-99-CHART, leave your question, and we'll tackle them on the next show. Who knows? Your question could be the next big topic we explore together.
So stay tuned and call 888-99-CHART to leave your comments. We're here to make investing accessible, understandable, and hopefully even a little more fun.
Chart your path to financial freedom here with the InvestTalk podcast. Now, our main focus point today, Luke, is about portfolio risk and how investors can really audit the risk in their portfolio overall. Now, the first thing most people that have to ask themselves is, what phase of life are they in? Is it the accumulation phase or is it the pre-retirement / retirement phase? Now, if you have more than 10 years left until you're touching any of your retirement money, then you are still roughly in the accumulation phase. Now, from there, it's not about your total risk allocation when it comes to your particular asset class. It's more of what is your exposure within that asset class. For example, if you just are investing in indexes, whether that's the S&P or total stock market index, you're going to be significantly overweight large cap growth. And most people are also significantly underweight foreign markets, right? So the question you have to ask yourself, Luke, is should they be weighted that much in large cap growth? Should they have more exposure to value? A simple solution would be maybe buying a value ETF, selling some of those broader market ETFs or mutual funds or even target dated funds, because that's going to be invested in a lot of index funds as well, and moving over to some sort of value type exposure. What do you think the best way to get that exposure? You think it's more in adding foreign markets or an ETF that is just value focused, and maybe they move down the market cap scale as well?
Yeah, both. I think the short answer is both. I think that in a way, people tend to think of how they allocate for their retirement portfolio as a mixture of a percentage of fixed income and equities, right? And traditionally speaking, as you're younger, you should have more equities and you should have less fixed income, and that should slowly fade into holding mostly fixed income when you're into retirement, because you actually need that money then, right? You can take on more risk of loss when you're younger, which gives you the ability to grow more. But you also need to get more granular, because not all stocks are made the same. Not all bonds are made the same. And specifically within equities, like you said, there is some risk to not holding international equities that may outperform U.S. equities, emerging market equities, value stocks. And so, I always like to think of risk not just as the amount of money you're willing to lose, but the threat of you being left behind. And so taking a look at the overall stock market on a global scale and seeing how much is allocated in global market cap to international markets, U.S. markets, value markets, the risk you're taking on there is any deviations from that market cap weighting. So I think it's important too within your equity slice, and ETFs are a great way to do it, especially if you're looking for international or emerging market exposure. You get into the emerging markets where you have a lot higher risk, but a lot higher potential for return, and it gets really complicated to hold individual stocks in some of those markets. So I think the proliferation of ETFs has made diversifying your retirement account or diversifying your brokerage account a lot easier, and I think most investors need to take advantage of that.
And the broad indexes are a perfect example of what we call in the industry style drift. Is they have a certain methodology, which is just a way for the makers of the index to switch certain companies in and out, and we don't really know exactly why they do it or how they do it, but in general, there is just a style drift that happens over time or has happened over time because it's a market cap weighted index. And so as long as they're not going to go kick out one of those larger larger companies, and therefore it is naturally drifted that way. Now, over time, and history says those styles change. Right. For example, Exxon was the largest company in the world in the early 2000s. And so it was the largest exposure within the broad market indexes, and then that shifted over time. And so if you were overweight at Exxon during that time, you probably underperformed many of the other types of assets. And so that could easily happen the other way, where you're currently overweight those biggest, most expensive companies in the world, and they could underperform some of those smaller names. So that's the way you want to think about it and why you want to broaden out your exposure. Now, let's say you are a pre-retiree or retiree. The first thing is, yes, you want to look at your overall equity exposure, but also your fixed income exposure. How much do you have? How much cash on hand do you have? And then what type of risk should you have in the fixed income slice? And the first mistake I see a lot with investors, Luke, is owning municipal bonds in taxable accounts when they're not in the highest tax bracket. That's the number one most common mistake I see, because really you should only buy these tax-free bonds when you're in the highest tax bracket. So that's number one, is understanding what type of exposure you have. Not all fixed income is treated equal, just like not all equity exposure is treated equal either.
Yeah, very true. It all comes down to suitability, right? Mm-hmm. If you are 65, 70 years old, just as it is not suitable for you to have your entire equity slice in small, non-profiting tech companies, it's not suitable for you to have your entire fixed income slice in municipal bonds. Because if you're retired, you're not making any money, you're not getting those advantages. So I think suitability is a big part of it, where investors just sometimes think, I want the most returns. And sure, you can get the most returns in those unicorn tech companies, but is it suitable for what your goals are and what stage you are in life? And oftentimes that answer is no.
And the most common risks in the fixed income market are duration risk and credit risk. And most people can, because of '08, are focusing a lot on that credit risk. And that's certainly something you should pay attention to, but it's no longer the number one risk you have to watch out for. It's duration risk. So it's not only what type of bonds you're holding, but how long-term are those bonds or not. And you want to stay on the shorter end. So those are the ways to kind of think about broader asset allocation exposure, whether you're far away from retirement or closer in retirement. Now, on the next InvestTalk, we'll look into this topic. Many banks have grants to help borrowers make their down payment. What you might want to know about grants for first-time home buyers. That story tomorrow, but for now, I'm Justin Klein and with Luke Guerrero, and we are ready to take your calls at 888-99-CHART.
Did you love today's InvestTalk episode? Well, we want to hear from you. So drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by us. Dive into the comments now and become a part of our next conversation. Do you want to take your investment strategy to the next level?
We invite you to visit InvestTalk.com and submit your portfolio for a free review from us.
This is a fantastic opportunity to receive personalized advice and insights to enhance your results.
Don't let this chance slip by. Go to InvestTalk.com, submit your portfolio, and let us help you on your journey towards greater investment success. Thank you for watching. Make sure you like, subscribe, and hit the notification bell so you never miss an episode of the InvestTalk podcast.
Hey, InvestTalk team. This is Steve from St. Paul. Love the show. Thinking about making a change in my materials sector. I own like half a position of PIC, Papa India, Charlie Kilo. Just looking in more detail at the holdings, it's very uneven and it just holds 250 names. The biggest name it holds is BHP at 13%. And I was thinking about selling the PIC. I'm up a little bit on that, but it doesn't move a whole lot, I think, in part because it's so diversified, and buying some BHP because of the copper producing names, Freeport McMoran, Southern Copper seem way overpriced right now. But the BHP is pretty reasonable, and they've got good metrics. Cash flow is a little bit of a concern, not terrible, but not great. But thinking that would be a better way to be in materials. I look forward to hearing your answer. Thanks. Bye.
All right. He owns PIC, P-I-C-K, which is the iShares MSCI Global Metals and Mining Producers ETF. It's correct. About 260 different holdings. BHP is the top holding, but Rio is second at 7%, Freeport 6.5%, Glencore 5.25%, and Anglo American a little under 4%. So it's kind of all over the place, but a lot of foreign names, which is very common in this space. And, he's worried about not doing very much because of that diversity, but then buying BHP, I don't know, it's been an underperformer. So I'm not sure why he'd want to switch out from something that is, by definition of itself, an industry performer, right, an average performer, into something that's a below average performer, where BHP's earnings this year are supposed to be down 26% from also being down 40% last year. I don't know. Yes, it's a diversified, large, $144 billion market cap company, but it's mainly focused on coal, metallurgical as well as thermal coal. So, in an era where coal is becoming more frowned upon, I'm not sure that BHP is the best play there. But I don't mind him focusing on individual name. Do you?
No, I don't mind him focusing on individual names. I think one of the reasons why you invest in a global ETF, like I mentioned before, is that it gives you global exposure, and it's easy and it's cheap, right? You pay 39 basis points. I do agree with you that BHP would be an interesting way to go. It underperformed the industry on average by 34% over the past 5 years. Now, that was primarily because in 2019 and 2020 they underperformed by 100% relative to the industry. So that certainly is skewing it. But given how costly and how much debt a lot of these companies have, for me, if you're going to throw all of your eggs into one basket, it doesn't seem wise to go with a company that is so heavily reliant on something that the world is trying to turn away from, right? And regardless of that, if that demand is going to fall as much as people think it is and shift towards renewables, it seems like a lot of excess risk to take, especially when you're essentially eliminating your materials diversity and just putting it all in one name. So I'm fine with buying a basket of stocks here, but I just don't think putting it all in BHP is the way to go.
And I also think that the companies that have moved the most, remember, in the commodity space, there tends to be durable trends because the shifts in demand and also supply can be long lasting. And I think in the copper space, you're getting that now with so much demand for electric vehicles and electric infrastructure, et cetera. And it takes 10 to 15 years to get a mine on market. So I rather pay up for something that's has major copper exposure, as opposed to, as Luke said, their major exposure, BHP at least, is into something that the world's trying to diversify out of. People are trying to use more copper, not less. They're trying to use less coal, not more. And so I would rather, if I'm going to pick an individual name, I would be looking for copper producers more than anything. Thanks for the call. Now let's play two in a row from the InvestTalk Voice Bank. You should know the number by now. It's 888-99-CHART.
Hi, Steve, Justin, and Luke. This is Kay calling from New York. Just wanted to get your outlook on IIPR. Back in the past, you guys have been pretty up on this stock. It's one of the only REITs that I do buy, and it's been down. Looking at it now at the opening of Thursday morning, and it's down almost 5%, and looking to get more. So just wanted to know your target price and your outlook on it. Thank you.
All right, looking at innovative industrial properties, IIPR. And yes, this is a name that we've owned for a while for clients. It bottomed back in early summer last year, around $65 per share. Now we're at 105.30 at the close today. And I'm assuming this call was after that earnings announcement, and it was down a little bit from 108 to about 104. And like I said, it's been recovering the last couple of days up to 105.30. It was overbought kind of going into those earnings, so it was a natural pullback, but still it didn't even reach the 20-day moving average. So, it's a mild pullback, and frankly, the technicals remain very, very strong, and the fundamentals are strong as well. It's supposed to earn $8.41 this year on funds from operations is $8.41. I always forget to say that when in regards to REITs, it's always funds from operations, not earnings. That's $8.41, supposed to be $8.69 next year on a $105 stock. We think it's still reasonably valued even after this run. It's obviously not as attractive as it was in the 60s or 70s last year, but still a quality name in a quality space. They buy industrial properties and they help license them for growing of medical cannabis. And they earn very high returns on those assets. And so we're big fans of it. And yeah, this is definitely one of the better REITs that are out there. Now, Luke, let's talk a bit about tariffs. And it was announced or leaked today that the Biden administration will be levying a lot of new tariffs on Chinese goods. Yeah, not the Trump administration, the Biden administration. What do you make of this news?
Well, there's actually one realm where there has been some consistency from the Trump administration into the Biden administration. I know when there was the change of hands in 2020, this is one of the areas where they actually didn't try and roll back what was done. And that's because historically, if you think about it, right, the Republican Party was, up until recently, the party of free trade. And the Democratic Party seemed to be more of the party of protectionism. And so with that shift in 2016, what you have here is essentially both sides wanting to, as best they can, protect American industries. How does it really work? We know that when tariffs are put in place, it tends to be passed on to the consumer. Costs become higher. But on the other side of this, I think there is a real threat that given how advanced China is on the front of renewable energy tech and the inputs into renewable energy tech, without something drastic and without some further enhancement of this, proxy trade war in a way, there is the threat that they dump a lot of goods into the U.S. market and can completely sink what could be one of the most important industries over the next 50 years. So I see it from both perspectives, but I certainly am going to be waiting to see what the official announcement is and their reasoning and how it might work. For now, this is just a lot of conjecture and an inside report. So it'll be interesting to see.
Yeah, and that's the worry, is that they are going to dump a lot of cheap products on our markets, and it's not something China hasn't done before. They've done that in steel and other industries, and obviously their economy is struggling, and so they don't have a lot of levers to pull, especially if they don't want to reignite a housing market that is just, I think they're trying to slowly deflate it from a massive bubble, especially considering the demographic situation. And so what levers do they have to pull? The best they know how is to pull the export lever. And, they've been ramping up production of renewable energy products, especially electric vehicles. And the expectation here is for tariffs to go from 25% on Chinese-made electric vehicles to 100%. Now, here's my question, Luke. Does that include the electric vehicles, Tesla-made electric vehicles that are made in China? Can they not export them here to the U.S. without that tariff?
Yeah, that's a good question. Certainly, I don't know the answer. I don't think anyone knows the answer, and that's because they haven't fully released their plan yet. So, like I said, I think we got to wait until the details come in. It's going to be interesting because, in a way, what's being chosen here is one of the initiatives is to further the green energy transition. That becomes harder when it becomes more costly, right? And this will undoubtedly make transitioning into renewable technologies and electric vehicles and all those things more expensive. Then on the other hand, there's American industry. So it's certainly, from what I saw, it seemed as though there was some infighting within the administration. Janet Yellen was on the side of actually lowering tariffs in some ways and having more of a strategic approach.
Well, she wants lower inflation, right?
Well, she wants lower inflation. Yeah, of course she wants lower inflation. Again, this is something that could harm some inflationary pressures as well. So, I think like I said, it's too soon to read into the tea leaves here, and certainly they'll come out with an official announcement. And I'm hoping that it's more strategically placed than a broad brushstroke.
Yeah, well, there are only two. This sounds big, but they're only the going from 25% to 100% sounds like a lot. But outside of Tesla, there are only two Chinese brands that are actually sold here. So and they don't sell very much. So it's not a huge impact there. But they could levy an additional 2.5% tariff on all automobiles imported in the United States. So you're talking about German-made cars, for example, Japanese-made cars, for example. So I think that will be the most interesting and wide-ranging impact overall. And once again, whether this impacts Tesla's importation of cars that are built in China. So that'll be very, very interesting. Let's see. And another thing to consider, too, is in many ways this could be a campaign ploy right? To say, hey, I'm even tougher on trade than President Trump. That certainly could be a ploy here. The campaigning last month in Pennsylvania, Biden said he would significantly raise tariffs on steel from China as well. So, China is a punching bag in an election year, and it doesn't shock me to see that as well. All right, now let's pivot over to another question from the InvestTalk YouTube channel. Carter Erickson says, what do you think of ACN? Is it good to buy and hold? ACN is Accenture, and this is a consulting firm mainly focused on the IT sector. And it's a large company, $206 billion market cap. This has long-term, Luke, been a consistent performer, consistent grower of its earnings. It historically doesn't really have a headquarters. It's kind of just operates throughout the world. But high return on equity, around 30%, 1.7% dividend yield. It's come down a lot, 20% off its 52-week high. And it's some pretty decent support here. Is it cheap enough yet?
Well, taking a look at a relative valuation perspective, it's trading at a 24 times price to earnings, which seems a little bit expensive to me for a consulting firm. It's trading at 7 times price to book. You mentioned they didn't have a headquarters. This name always makes me laugh because, Accenture used to have a different name. Do you know what it was?
What?
Arthur Andersen.
Oh.
Yeah.
I didn't know that.
After the Enron collapse, they spun off their consulting business into a different firm, called it Accenture, and here we are today. So they did used to have a headquarters, and they used to be pretty infamous. But, I think overall the business has certainly run well. I just don't know with a consulting firm that is going to ebb and flow typically with the business cycle, and there hasn't been much market stress since 2008, 2009 that would drastically reduce profits. I don't know. 24 times seems pretty expensive to me. 7 times on price to book seems pretty expensive to me as well.
Yeah, the positive here is they have a very good balance sheet. Pretty much net cash on their balance sheet, and not a ton, but a little bit. A return on equity around 26%, trailing 12 months, and historically the 5-year average is about 31%. So that has been coming down. So that would be my biggest worry, is what's happening with profitability. Why is profitability shrinking a little bit? But it's still at pretty high levels. And I like the balance sheet. It's just historically it doesn't get cheap until you get enterprise value to EBITDA closer to 12 to 13, and it's at 17 now. So obviously much better than it was just a couple months ago when its enterprise value to EBITDA was closer to 21. But I would be patient. I would probably buy this around $250 per share. Now we're at 307. I think that would be my target. If it gets there, then I think it's worth it. Thanks for the call, or thanks for the comment on our YouTube channel. Now this is InvestTalk, now with over 58.7 million downloads. Let's roll in to another voice bank question now.
Hey guys, I want to first thank you guys for the show. I'm a frequent listener, and I got a question about AMC. What is it doing? It dropped way down. Not sure what I missed, but I would love to have information on it. Thank you.
Well, we kind of answered this at the top of the show, right? I'm assuming he called in sometime today to leave this. AMC was, what did I say it was up? 70%? Something like that?
Something like that. I thought I heard him say that it dropped down.
Yeah, maybe. Yeah, I don't know if. That's what I thought I heard.
Before.
But it's dropped down from where it was back in. Let's see, that was August of last year when it was trading in the 50s, and then. Not sure what happened. Oh, there was, it looks like a split, a reverse split. Yeah, reverse split.
Yeah.
And then
to stay listed.
To stay listed, yep. And it's just ground lower all the way down to before today in the $2 range. Now we're at $5.19 per share. Not anything that you want to chase unless you think the squeeze can keep going. You think the squeeze can keep going?
It could. It also couldn't. It's difficult to say. That's the problem with not investing for fundamental reasons with a company and not investing to investing. This is gambling. This company doesn't make money. I used to love going to the movies before the pandemic. I haven't stepped foot in a movie theater in so long. And a lot of the business was killed by the pandemic and sped along by the fact that people can watch movies at home. Streaming.
Yeah,
and it's eating away at it. So
if you want to gamble,
stay away.
Head to Vegas. Yeah.
That's true.
This is InvestTalk. I'm Justin Klein with Luke Guerrero, and we have one goal each and every weekday, and that's to help you achieve your own version of financial freedom. And our work continues after this final break So if you're going to call, you want to do that right now at 888-99-CHART. Enjoyed our insights on InvestTalk? Great news. Our podcast is available on all major platforms. Make sure to subscribe wherever you listen to your podcasts. Get the latest in investment advice across Spotify, Apple Podcasts, and more. Subscribe now and join our community of informed investors.
Is something on your mind? You can call us 24/7 at 888-99-CHART with all of your finance and investment questions.
Hi, Justin and Luke. Matt from South Florida. Interested to get your thoughts on ticker symbol ACIW, which is ACI Worldwide. Was looking to expand some of the payments equities in my taxable portfolio. Looking to hold it for maybe something like a 5 to 7 year time horizon. Wanted to get your thoughts on the outlook on this stock in an effort to sort of broaden beyond the usual suspects of Visa, Amex, and PayPal. Thank you.
Are looking at ACI Worldwide. I thought this was a merger between Albertsons and Prestige Worldwide myself, but it is not. It is looks like a payment processor. It sells software to the looks like banking industry. Is that? I'm trying to figure out exactly what this company does.
I'm so angry because their business segments could have been called billers, banks, and businesses, but instead they're billers, banks, and merchants.
That's unfortunate. Well, it looks like they sell their products to utilities, healthcare providers, community banks, credit unions. Okay. It is worldwide. It's all over the world. Earnings this year are supposed to be down 20%, though, and up 58% next year to an all-time high. And I think that's what what's the market seeing is that the stock went from about $20 per share back in early November all the way up to $36 per share today. So you're up 80% in 6 months. That's a pretty big move. I don't know. Would you chase it here?
I mean, it looks a little expensive to me. It's trading at 22 times, and for a payment processor that.
But if
honestly,
it makes 238 next year, then it's only trading at about 15
The revenue's
times.
kind of stalled. It looks like most of the revenue growth was in 2018 to 2019, and then they're kind of trickling in after that. They had some growth in 2021, which I guess makes sense because people were transacting not face-to-face. And so I just don't see that type of multiple at really not much revenue growth with the exception of one significant event that really isn't going to repeat itself, at least for the next couple of years, I would hope. So I think I always have problems with payment processors because I think it's one of those businesses that is really duopolized.
And there's no real moat, right? Unless
No,
you're Visa or MasterCard.
Yeah, no, that's what I'm saying. It's like it's difficult to pick those guys off. And so when you're trying to facilitate real-time electronic payments, there's a lot of inertia there. And so what you're seeing here is exactly what I'm talking about, which is there's not a lot of growth. There's growth potential. It's just that they're not capturing a lot of growth here. And so if you're up that much,
I would just need to know why it's supposed to earn 234 next year. Why are earnings supposed to go up 58% next year? What is that reason? And is that sustainable? Because historically, this company, its earnings are kind of up and down. There's usually not a ton of growth. And I would need to be very confident.
I see it at 180 in 2025.
I have it at 234. So maybe that's different systems with different estimates. But it would have to really fulfill that and then some to make this move sustainable. All right, now let's pivot lastly to the winners of 2020, winners of the pandemic. And Luke, the top 50 winners during of equity returns in 2020 have lost roughly $1.5 trillion in market value since the end of 2020. And some of the most infamous names are Zoom, down over 80% since its peak. Peloton, that one is down 97% from its peak. That was the most obvious one because they couldn't even make money during the pandemic. So how are you going to make money outside the pandemic? And clearly they haven't. And then Companies like Ring Central down 90%. Just a lot of big, giant losers from that top. What is the biggest takeaway you have from the vast majority of these names just being huge destroyers of capital since then?
Putting an iPad on an exercise bike isn't a business model. No, I think the thing here is that people tend to have recency bias. And when there's this whole shift, this wholesale shift across industries to a work from home environment, everyone thought that was, or invested like that was going to be the case forever and for always, right? But the reality is the world tends to be more like it has been rather than how it is immediately right now, right? And so people extrapolated those trends in a way that was not the best for their investment portfolios in the long term, and certain fund managers who will not be named certainly paid the price for that.
Yeah, and I think that's the best word there, extrapolation. When you extrapolate very, very short-term trends in an environment that was entirely in some ways fabricated, right? Obviously there was going to be reversion to the mean, and this has been the biggest example of that. So that about does it. I'm Justin Klein here with Luke Guerrero, and this completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well, and check out our videos over on our YouTube channel. Just search InvestTalk with 2 T's. Independent thinking, shared success. This is InvestTalk. Good night.
Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.